At its peak, it was worth more than SpaceX and Airbnb combined. Just a few months later, it was on the brink of total collapse. This is the story of how a company valued at $47 billion imploded, and the one powerful mistake everyone missed until it was too late. The story begins with two founders, Adam Neumann and Miguel McKelvey. They saw a world transformed by the internet, where freelancers and small startups needed more than just a coffee shop to work from. They needed flexibility, community, and a cool place to be. The idea for WeWork felt inevitable. It wasn't just about renting desks. It was about selling an experience, a lifestyle. The market believed in the story of a tech revolution, a new way of working. But here is the subtle hint that something was off from the very beginning. WeWork was in a tech company. It was a real estate company. And Neumann wasn't just building a business. He was building a brand around himself, fueled by charisma and grand pronouncements. This set the stage for a dangerous blur between vision and reality, a path that would lead them to chase impossible growth at any cost. If you enjoy deep dives into business stories like this and want to learn how to spot the signals others miss, consider subscribing for more breakdowns. Let's get back to the story. The turning point came in 2017. That was the year SoftBank, a massive Japanese investment fund, invested over $4 billion into WeWork. To outsiders, this was the ultimate validation. A tech visionary, Masayoshi son, was betting big. WeWork wasn't just a successful startup anymore. It was a global phenomenon destined to change the world. But inside the company, this massive cash injection felt like pouring gasoline on a fire. The pressure to grow, to expand into every city on Earth, became immense. The mission shifted from building a sustainable business to justifying an ever-increasing valuation. This moment locked WeWork into a dangerous path because it rewarded speed over strategy. It told them that their story was more important than their numbers. From that day forward, the company was no longer just leasing office space. It was in a race against its own hype, a race it was mathematically destined to lose. So, what exactly did they do with all that money? Their strategy was built on a few core pillars, each looking brilliant at the time. First, they pursued Blitzscaling, hyper-aggressive global expansion. The logic was simple: get big, fast. Be the number one player in every major city before anyone else could compete. It looked smart because in the tech world, market leaders often win everything. The assumption was that WeWork was a tech company and that network effects would kick in. But that assumption failed. A WeWork in London doesn't make a WeWork in Tokyo more valuable. They were separate, costly locations, not a connected digital network. It was like thinking that opening 1,000 Starbucks at once would somehow make the coffee cheaper to produce. Second, they spent lavishly on aesthetics and perks. Free beer, custom furniture, and beautiful, modern designs. The logic was that a premium environment would attract premium clients and justify high prices. It seemed smart because it built a powerful, desirable brand. People wanted to be part of the WeWork club. The assumption was that customers would pay a significant premium for these vibes, enough to cover the huge costs. This failed because when the economy tightens, companies cut costs. Free beer is the first thing to go. The vibe wasn't a strong enough defense against basic financial reality. The core service was still just a desk, and competitors could offer that for less. Finally, they started acquiring other businesses, everything from a wave pool company to a private jet service for the CEO. The logic was to build a complete ecosystem around their community, from living to working to playing. The assumption was that WeWork could become the center of its members' entire lives, capturing more of their spending. But this assumption failed spectacularly. These acquisitions had nothing to do with the core business of office space. They were expensive distractions, burning cash and confusing the company's mission. Instead of strengthening the core, they were just adding more holes to a sinking ship. The numbers told a terrifying story if you knew where to look. On the surface, growth was explosive. Revenue was doubling year after year. The company was opening new locations at a dizzying pace, adding hundreds of thousands of members. To investors, this looked like the classic hockey stick growth of a future giant. They kept saying yes to more funding because they were mesmerized by the top-line revenue. They were betting on the charismatic founder and the grand vision, not the boring financial statements. But underneath the shiny revenue figures, the losses were equally explosive. For every dollar WeWork earned, it was spending too. The company was burning through billions of dollars a year. This created a massive tension. The bigger they got, the more money they lost. It was like a car accelerating towards a cliff, with the driver convinced that at some point, it would learn to fly. Then came the moment belief collapsed. In 2019, WeWork filed its paperwork to go public. For the first time, the entire world could see the shocking reality of its finances. The document revealed not just the staggering losses, but the bizarre corporate structure and the founder's questionable self-dealing. It was all there in black and white. The story unraveled overnight. The uncomfortable truth no one wanted to say out loud was suddenly undeniable. WeWork was in a revolutionary tech company changing the world. It was a wildly unprofitable real estate company with a messiah complex. This single sentence reframes the entire story. They weren't selling a service, they were selling a stock. That was the real product. I have to ask, who do you think carries more blame for this collapse? The founder who sold the dream, or the investors who bought it without question? Let me know your thoughts in the comments. Now, let's get back to the story. So what can we learn from this incredible collapse? There are a few powerful lessons here. First, a great story is not a substitute for a great business model. WeWork had one of the most compelling narratives in modern business. But charisma and vision don't pay the rent. Smart people, especially investors caught up in market hype, missed this because they wanted to believe in the next big thing. You can spot this early in other companies by asking one simple question: how does this business actually make money? If the answer is complicated or relies on some future and proven magic, be skeptical. Second, beware of the growth at all costs mindset. WeWork was addicted to growth because its valuation depended on it. This led them to make reckless decisions. Smart people missed it because in a bull market, rapid growth is celebrated above all else. They confuse scale with success. You can spot this by looking at a company's unit economics. Are they losing money on every single customer or sale, hoping to make it up in volume? That's a huge red flag. Third, culture starts at the top. The chaotic, party-fueled, and unaccountable culture at WeWork was a direct reflection of its founder. It prioritized appearance over substance. People inside the company likely saw the problems, but the culture made it difficult to speak up against the vision. This is a subtle but critical point. You can spot this by observing how a leader talks and acts. Do they take responsibility for failures, or do they only talk about wins? That tells you everything you need to know. These ideas apply far beyond just WeWork. If you enjoy breaking down real business stories to understand what truly drives success and failure, you might want to subscribe. We have more case studies like this one coming very soon. Thanks for watching.